If you're new to crypto, it's easy to take today's experience for granted. Buying and selling and moving money around, it feels pretty seamless now. But that wasn't always the case. Back in the early days, banking access around crypto was often limited, and getting money in or out of the market was much less straightforward. People needed something that could move money like crypto, but hold its value like cash. Stablecoins were the answer. Digital assets designed to hold a steady value, usually $1. The biggest ones generally do that by holding real reserves, like cash and short-term government debt. Now, at first, stablecoins were mostly a tool for traders and exchanges, but now they're becoming something much bigger. And 2026 is the year they stop being just a crypto story and they start becoming part of everyday finance. The stablecoin market is now around $300 billion. Transaction volume hit $33 trillion in 2025, and regulation is finally catching up. In the US, the GENIUS Act created the first federal framework for payments of stablecoins. In Europe, MiCA now requires issuers to be licensed and hold proper reserves. So, for the first time, there are real rules around what backs stablecoins, how they're disclosed, and also who can issue them. That makes it a lot easier for businesses, platforms, and regular people to trust and use. And there are hundreds of stablecoins to choose from, but the two you really need to know are USDT and USDC. Together, they make up a vast majority of the market. Both of those aim to maintain the same $1 value, but they've grown in very different ways. Tether's USDT is the biggest, with around $184 billion in circulation. It's the most widely used and still the default stablecoin on many exchanges. USDC is issued by Circle. It's smaller at around $77 billion. Now, what makes it stand out is its approach to compliance. Circle gives regular updates on what backs USDC, and USDC is now the largest EU-regulated stablecoin under MiCA. That doesn't automatically make it better, but it does mean it has clear regulatory footing. Now, that's one of the reasons why Visa and Mastercard are both using USDC as part of their stablecoin strategy. Stripe is building stablecoin payment infrastructure too, and JPMorgan has launched its own tokenized deposit product. These are some of the biggest players in finance, starting to integrate stablecoins into how money actually moves. And the reason? Well, it's pretty simple. Traditional money can be slow and expensive to move, relying on intermediaries with office hours. Stablecoins live on the blockchain, which makes them faster, cheaper, and accessible 24/7. For companies that are processing billions in transactions, that difference adds up very fast. Visa has said that stablecoins can speed up cross-border movement and free cash that would otherwise be tied up in multiple currencies around the world. And it doesn't just stop at payments. Stablecoins have got so large that the biggest issuers are now major buyers of US government debt as part of the reserve backing them. That tells you something. Stablecoins are starting to matter to the wider financial system and even to the role of the dollar itself. So how big could this get? Well, JPMorgan's high-end scenario sees the market reaching $2 trillion within 2 years. Now, whether or not that prediction comes true, the direction is pretty clear. Stablecoins are growing fast, and the rest of finance is paying attention. But stablecoins aren't just for big companies. They're solving real-world problems. In countries where local currencies are losing value, holding dollars is often seen as a way to protect your savings. But getting access to dollars, it isn't always easy. You might need a foreign bank account, access to an exchange market, or to have to pay steep fees just to get in. Stablecoins can change that. With just a phone and an internet connection, most people can hold digital dollars. Now, we've seen in countries like Argentina and Turkey, where users have been turning to digital dollars as local currencies weaken. And then there are remittances, where people working abroad send money back home. This is one of the most important financial flows in the world, but it's often one of the most expensive. A typical transfer can take days, and high fees can eat away at amounts spent. The World Bank says the global average cost of sending remittances is still 6.49% of the amount sent. Now, a stablecoin transfer is much cheaper and can also settle in seconds. For millions of people sending money to families across borders, that can mean rent arriving sooner medicine paid for faster, school fees that don't lose value while the money is still stuck in transit. The impact is massive. And that's the bigger point. Stablecoins are no longer just a tool for traders. They're changing how money moves and solving problems traditional finance still struggles with. If the last few years were about proving the concept, 2026 looks like the year stablecoins start scaling in the real world.